Well, let's get this straight. Gold is hitting new all-time highs in nominal terms, not inflation-adjusted terms. I think that the gold market is, as we described it the last time you and I talked, a coiled spring. And I think it's wrong, at least from my own viewpoint, as an old guy, uh, to think of gold as a speculative element. I think you think of gold as an insurance element.
Right.
You may not recall, but the last time you and I talked, I said that I didn't own gold because I thought it might go from 1950 to 2110.
Hmm.
I owned it because I thought it might go over 5 years to 8,000 or 9,000 or 10,000, at least in nominal terms, based on the declining purchasing power of the US dollar. I continue to believe that the momentum must be established by gold. The narrative has to be established by gold. If that happens, and I believe it will, experience tells me that silver will move later, but silver will move further and silver
Hmm.
will move faster.
Renowned investor Rick Rule provides insights into the gold and silver markets, emphasizing gold as an insurance element and silver as a speculative opportunity. With gold hitting new all-time highs in nominal terms, Rule sees it as a momentum setter for the broader narrative. He anticipates silver to follow, moving later but faster and further. Rule strategically allocates gold in the insurance part of his portfolio and holds silver in the speculative segment. He cautions about the potential for a false start in gold, but remains optimistic. When it comes to investing in smaller companies, Rule prioritizes experienced and successful management, emphasizing familiarity with the geographic and geologic environments. In the silver space, he seeks quality, favoring companies with at least 100 million ounces of recoverable reserves, aiming for top-tier returns on capital employed and low all-in sustaining costs. With that, let's dive into the video to hear his full thesis.
I own silver in the speculative part of my portfolio. I own gold in the insurance part of my portfolio. So I hope that helps. Could this be a false start in gold? Sure, absolutely. And you have to organize your portfolio to understand that you might be early. In the smaller companies, it's all about people.
Hmm.
And have they been successful before? And have they been successful in a task that closely resembles the task at hand? If somebody has been successful operating a gold mine in French speaking Quebec, and what they're doing now is exploring for silver in accreted terrain in Spanish speaking Peru, the prior success isn't necessarily relevant to the task at hand.
Right.
So I want somebody who is familiar with the geographic and geologic environment that they're already working in. If
Hmm.
you have a more mature company, which is to say the deposit's already been found, the first thing I want is scope and scale. Uh, Really, for me, the minimum target size or the minimum reality is 100 million ounces of recoverable reserves and resources. I'm not interested in small mines. What I
Yeah.
found is
Right.
that small mines have all the risks of big mines, but they can only ever make you small money. And the idea that
Mhm.
I would take a big risk for a small reward is sort of silly. I also want at least a target, but preferably a reality that will be in the best quartile in the industry in terms of return on capital employed, certainly over 25%, and the lowest quartile in terms of all in sustaining cost. Because remember, in the silver business, most silver is produced as an adjunct to
Yeah.
base metals mines, which means that the production costs are very, very, very low for most silver production. Most silver production simply involves the recovery of silver from the waste stream.
Hmm.
So primary silver producers have to be extraordinarily efficient. And while there's an argument that you would buy a high cost producer because their margins would expand more rapidly with an increasing silver price, for me personally, that's too risky a strategy.
Right.
I did it in the early part of the 90s. It worked, but then the silver price was too stupidly depressed. I want quality now in the silver space.
In the continuation, Rick Rule emphasizes the importance of a geologist's background, matching the exploration terrain, and advises speculators in gold and silver markets to consider the potential impacts of Fed rate cuts. He challenges the belief that rate cuts are a guaranteed positive for precious metals, cautioning that market responses and the longer-term dynamics need careful consideration. Rule points out the Fed chairman's reluctance to cut rates due to fiscal irresponsibility in Congress and suggests that the real response in gold and silver may take time, possibly 2 to 2.5 years after a rate cut. Investors should remain vigilant and not underestimate the lessons learned over 40 years of economic trends.
Jurisdiction and geology. If
Yeah.
somebody's background is Archean geology, and all of a sudden they're looking in accreted terrain in tertiary volcanics, the success that they enjoyed in an Archean terrain
Won't
is
be the
not
same as-
necessarily technically transferable
Yeah.
to accreted tertiary terrain. Speculators who believe that this is nirvana need to think about three things. It might be that the Fed chairman is lying.
Mm.
It might be that simply jawboning about lower rates will re-inject confidence into the economy. And so I think that investors need to test their perception to the downside. I'm not saying he won't do it. I'm saying that the economy is surprisingly strong, given a doubling of interest rates, and he may not have to cut rates. I suspect that he is loath to cut rates because of the fiscal irresponsibility of Congress. So he will only cut rates if he has to. If he does have to, then really it's going to be a function of the market's response in various circumstances. To the extent that your listeners are holding speculative gold and silver stocks, one thing that they need to consider is the amount of speculative capital that will go into technology rather than into gold and silver. So I think that people who, again, believe that rate cut is nirvana need to understand that they need to pay attention to the market's response in the near term to cutting. In the longer term, while the real inflation rate stays much higher than the Fed acknowledges, while the compensation available to investors in savings products declines, I think what you'll see is, in a normalized world, the real response in gold and silver would take place 2 years or 2.5 years after the rate cut.
Oh, wow.
I think you might see a move in anticipation, but
Right.
it's important to note that what really drives gold and silver is investor and saver expectation as to the maintenance or lack of maintenance of their purchasing power in US dollar terms. And that doesn't happen in 3 months. We've had 40 years of a strong dollar and declining interest rates. And the idea that you can unlearn the lessons that you've learned in 40 years over 3 months or 4 months is fairly silly.
Today's discussion with Rick Rule has been a deep dive into the gold and silver markets, offering valuable insights for investors. Remember, gold is not just a speculative element, but an insurance asset, setting the stage for silver to potentially move faster and further. Rule emphasizes the significance of people in smaller mining companies and the importance of aligning geological backgrounds with exploration terrains. As we explore the potential impact of Fed rate cuts, it's crucial to test perceptions and consider the market's response. If you found this information valuable, don't forget to subscribe, like, and share your opinions in the comments below.